Welcome to B-tirement. Today we have a very special video. Last week I published a video about Stretch, which is one of Strategy's preferred stocks, alongside their other preferreds, which is Stride, Strike, and Strife. And one of the new revelations about those great dividend-paying stocks is that they would be tax deferred because they have ROC treatment, or return of capital treatment. And I got a lot of comments and questions about what that meant. And that really went beyond my area of expertise, so I phoned a friend. So today we're joined by Jordan Guess, who's a CPA, and he focuses especially on the Bitcoin space. So I reached out to Jordan and asked him if he could join us here today, and looking forward to this call. So, hey, Jordan, why don't you introduce yourself?
Yeah, Michael, I appreciate you having me on, and this is fun. We know each other from running into each other in some different meetups, and so it's good to be on podcast with you and kind of talk through these details in more depth. My background is CPA. I run a tax firm, and I'm also co-founder of Bitment, a Bitcoin accounting and tax software, and we're working mainly with small business owners. They don't all have to be, they're not all Bitcoiners. Some of them just run more normal businesses. And then we work with a good chunk of higher net worth folks who are, looking to just be as efficient as they possibly can with their tax situation. So offer services like tax preparation, tax planning, bookkeeping, payroll, if that's necessary, and sales tax, that kind of stuff. But I'm really excited for this conversation. Like you, I've gotten several questions on it's always that one of those things, right, where it seems too good to be true. Is it too good to be true? So I'm excited to kind of dig in and we can talk through everything. One last thing, and I'll pause, is, anytime I want a show like this, have to make sure that we have a disclaimer that, we're talking about tax, and there are some topics that we can broadly discuss at a high level, but each person's situation is, unique. And so I would definitely say, before you make any decisions, you really should, take the information that you are provided on this podcast with and either take it to the CPA that you work with for your annual tax filings to talk it through there, because you just really want to make sure that the advice you get is personalized, because I can't obviously know exactly what's going on in everyone's situation. So just want to always point that out, that, feel free to either reach out to our firm and we'd be happy to set up an engagement with you, or again, just reach out to who you normally work with, and happy to connect with that person as well if they have any questions. So.
All right, excellent. Thanks, Jordan. So now I'm going to ask a few questions just based on those comments that I received on last week's video. And I'll start kind of broadly. Can you share generally what return of capital dividends are, what that history is, and why they apply to the strategy preferred stocks like Stretch, Stride, Strike, and Strife?
Yeah, I mean, it's a very interesting, way to return the capital and do it in a much more tax efficient way. I'm not totally sure exactly where they started. I did some research. It seems like they started because of some investment trust that popped up, back in the last century. But the main thing is, like, in the prospectus for these different investment vehicles, Saylor he's pointed out that this is the treatment of these dividends. And so we can kind of get into the mechanics, but the main piece of the puzzle is that it's in the prospectus. This is the tax treatment. And so people are going to, do with that information what they will. And it's especially good for anyone who is already in a very high tax bracket and just cannot afford to, not necessarily can't afford, but if they are having to pay taxes on their investment income, it's at potentially higher rates than other folks who are in lower brackets. So it's just like, there's a lot of different reasons to be interested, I would say, in all of the MSTR suite of products at this point. And this is just kind of the icing on the cake of, wow, I'm going to get these dividends and they're at least going to be tax deferred. That's a very interesting thing for investors to look at.
Great. And that kind of leads into that next question I had, is that my understanding is the ROC means tax deferred and not tax free. Can you explain how this works and when you would pay taxes on the dividends you receive?
Yeah, so since it's a return of capital, in the same way, like if you just invested in a business, right? And so you made a contribution into that business, and now you're taking money out of the business. You know, that is again that's a basis calculation, right? So when you put the money in, that increased your basis in the company's stock. And then if you pull that basis out, or sorry, you pull that capital out, that's just a return of capital, and there's no taxability on that. And so that is how these dividends have been structured, is like if you put $100 in and then you get $10 dividend payments, that is just coming off of your original basis was $100, then it's 90, then it's 80, then it's 70. That's just one example, right? So and then when you go to then eventually sell the stock, then it's the calculation is the proceeds that you got for selling shares minus the basis that you have in those shares. And so if you were taking return of capital dividends, obviously that's lowering your basis and creating a larger gain upon sale. So it's one of those things that, again, if you are just in it for the long haul, you could at least fully deplete your basis on a tax deferred manner. And then you could also think of, there's definitely some estate planning to touch on in here, because then if you, pass that stock on to the next generation upon death, then the next generation gets a step up in basis. And that's just one interesting thing to think through, especially if it's, I think a lot of folks who are interested in Bitcoin investing, MicroStrategy or strategy investing, they're kind of in it for the long haul. And so that would be one way to actually fully get out of the taxes, is get your basis out tax deferred, then you get the step up. One last thing to just mention is that if you can kind of imagine that same scenario we just painted, of you put $100 in, you get $100 back out from the return of capital dividends, but now you're at a $0 basis. So what happens on the next dividend payment? And just should be pointed out that once you deplete the basis, the dividends then flip to having capital gains treatment for those payments specifically. Just since you're zeroed out, you can't return capital that you didn't put in, kind of thing. So
okay, great. And just make sure I understand, I'll kind of relay it from my way of thinking. If I buy a share of Stretch today for $100 and hold it for 5 years, and in those 5 years I receive $50 of dividend payments, basic numbers, $10 a year.
Mm-hmm.
And so my basis is then reduced to $50.
Yeah, in that scenario.
And if I sell after that 5th year and my basis is 50, then my capital gain on that investment was my purchase price, which was $100 minus 50. So I pay capital gains on that capital gain of $50.
Almost. The only difference is that we don't necessarily know that the first number, the proceeds, is what you would actually sell it for. So if it went up in value, then it would be that minus the 50, or down, whichever direction it went.
But Stretch in particular, they're trying to target it to stay right around $100. So it might be 99 or 101. So sure. Yeah, I think So I sell it for 100. I'd bought it for 100, but received $50 of dividends. So my basis is dropped down to 50. So my proceeds, which was $100 from my sale, minus 50, means I pay $50 capital gains on $50.
Yep. And in that case, you'd also pay long-term. It'd be the long-term capital gains rates on that $50 difference. Yeah.
Okay. Great. And then your last point was, let's say I hold it for 11 years and my basis is now down to 0 and it can't go negative. right? My basis can't go negative. So after I receive, if I buy it for 100, I receive 10 dividend payments of $10 each. So now my basis after 10 years is 0.
Mm-hmm.
And I receive another $10 dividend, then that would immediately, or in that same tax year, be taxed as capital gains.
Yep, exactly.
Okay. All right.
Yeah, I mean, it's very interesting. I'm a little bit removed from, like, I went to the strategy conference, I guess back in, I think it was April, March or April of this past year. And then I actually just saw Saylor. I just saw Saylor at an event in Naples just this past week. We actually both spoke at the Naples Family Office Symposium, although I didn't get to meet him. So that was a little sad, but that's all good.
That's
So I
that's
always
awesome.
feel bad for people who have to interview Saylor
Yeah.
because they get
It
like one sentence in and that's it, right?
Well, good or bad, right? It's an easy job because you ask a question and he talks for 45 minutes and it's just brilliant stuff.
Yeah,
But yeah,
no, for sure.
yeah, you might not get through all your questions, but cool. So the next question I had for you is, does ROC treatment provide any benefit if I hold the shares, like the stretch shares, in an IRA?
There's really, yeah, there's really not a great big benefit just because, I guess the only, like, you think about it like this, like if you foresee a world where you are going to sell the shares, right, uh, to, pay for living expenses, and say you got the dividends, they were, non-dividend distributions is how they're reported on the 1099s, or if they're in the retirement, then they're not reported at all. But that does lower your basis. You just kind of got to think, like, if I am going to end up in a situation where I sell this, do I, potentially want it to be in some kind of tax, either just tax advantaged account, right? So if it's in a Roth, you're getting all of those, dividends that are paid out to you, obviously not taxed. You could reinvest all of those. But then when you went to pull it all out, then there's no taxes at all. So there, in that scenario, that would be very nice because even if your basis is extremely low, there's no taxes in a Roth type of vehicle. Um, Same, or similar in traditional, right? It's just a timing thing where you would pay the taxes upon the distribution. So there is definitely some, I guess, for long-term planning and for, the situation where you're going to need to sell the shares in order to, pay for living expenses and all that kind of stuff into retirement, then makes a lot of sense to consider putting that in a tax advantaged account, be it a traditional or Roth. But if you are just like, I guess you can just think about the dividends that are being distributed. Those are not taxable. And then again, if you are just thinking, well, I'm not necessarily going to sell this, I'm just going to leave it. There's a world where you deplete the basis and then potentially just hand it off to the next generation. So
Yeah, great. Yeah, it seems to me like the clear benefit is in taxable accounts, because as long as I want to hold long term, it's great to defer those taxes. And Strategy has said that they expect this rock treatment to be in place for at least 10 years. And, it should take about 10 years, maybe 8 or 9, with compounding uh, of those dividends to deplete the basis. But definitely in a taxable account, if you plan to hold, if you're buying and selling and trading these shares, it really doesn't have any big benefit, right? If I receive some dividends and sell in the same year, I'm paying basically the same tax as I would. Is that right? Is the tax rate? How's the tax rate compare of dividends versus short term or long term capital gains?
yeah, I mean, the short term just depends on what your other income is. So then it's just treated like ordinary income. And, so if you're in the top 37% bracket, that's what you're going to have to pay for anything that's, treated as short term. So that's why it's real important for folks to get that long term capital gain tax treatment because the max is 15% on that, versus the max being like 37%. And you've got to also consider the state taxes for wherever you're living and working. But yeah, it's very important to just, if you can hold for at least a year, it's, much better, especially if your income's generally pretty high. So,
Right. Next question. I found these forms. I was on the investor relations section of Strategy's website, and I stumbled on these form 8937. They had one of these for each of their 4 preferred: Stretch, Stride, Strife, and Strike. And I believe it relates to this rock treatment. Curious if you know what this is and what the purpose of this form would be.
yeah, it's mainly just to send to investors and to the IRS the correct basis reporting, right? Since that's like the main crux of everything that we're doing with this vehicle is like, what is the cost basis for each of these investors? In the same way that they send out we send out a 1099 that shows the IRS, hey, here's the income for the year, and tell the IRS that, tell the taxpayer that. This is to be used for the investor or taxpayer to know exactly what their basis is. So it's really just a reporting mechanism for the cost basis, so that folks can have that on record, and then so that the IRS can know, okay, if this is ever to be sold, we have a record of what this cost basis for the different accounts are. So that's really all that is. To be honest, I haven't seen it a whole lot, but it sounds like it's something that Strategy is going to be filing, I guess, on your behalf, is my understanding. Either that or potentially the brokerage. I'd have to check on that to see if the actual brokerage is filing that with the 1099. That might be the case. I'd have to go check on that because I'm just not for sure.
Okay. And then how about dividend reinvestment? I know some of the brokerages allow, if I receive a stretch dividend, to reinvest that immediately back into stretch. How does that affect the tax treatment?
Yeah, so once you reinvest the dividends, those actually are getting the same cost basis as the shares that you had originally. So it's not taxable to reinvest those dividends. It's just a matter of tracking that cost basis for the shares that you did already have. So they just essentially get the adjusted lower basis, and that happens proportionally across all the different dividends that you're reinvesting. So I would say, again, this whole exercise is like, it's one of those things where you're probably wanting to track your basis in the same way many Bitcoiners have had to learn that they've had to track their basis and their Bitcoin in spreadsheets or however they decide to do that. It's a similar exercise, knowing that you're probably going to want to track the basis of these investments on your own, just in case. And I mean, I've seen it happen a lot where, either we moved investments from one brokerage to the next, maybe it hopped a couple different times, and that ending brokerage just does not have the cost basis data in order to file the 1099 correctly. So then we have to go back and do some digging. So I think it would be best for everyone to, take it upon themselves to probably be tracking their basis meticulously themselves in some kind of Google Sheet or Excel doc, just so you can always check if you were to go sell any of your positions, like, hey, does this match up what I've got in my records for the cost basis for this lot? So.
Okay. Yep. Makes sense. Yeah, those of us that have spot Bitcoin know that we hopefully are doing that, because it gets complicated if you get behind.
Yeah.
Or as Saylor says, just never sell your Bitcoin. Then you don't have to worry about the capital gains. But I know things might come up, and we might want to sell some at some point.
Sure. Yeah.
And kind of related is how will brokerages handle these? Will they know how to treat the rock dividends? And Fidelity, Schwab, Robinhood just in recent weeks added the availability of these strategy preferreds to their site. Do you expect that they would know how to handle these and how to properly report?
Yeah, I mean, again, it's one of those things where you want to check your 1099s before you send them over to your tax person to make sure, but they should be uh, reported on a 1099 on a 1099 div, but they would be listed on the non-dividend distributions line. So that's the main thing to look out for is pull up that 1099, make sure that the line's there. Because if it's blank there, for example, potentially it's been wrapped up with your ordinary and qualified dividends more towards the top of that form, and that would be a situation where you'd want to go back to the brokerage and request that they issue a corrected 1099.
Okay. All right. Jordan, I think that's the questions I had. I'd gone through the comments of this last week's video and kind of summarized and rolled those all together. So I think we touched on everything that's come up, and the doubts that I had or the questions that I had. I really appreciate the time that you've took today. So do you want to provide any contact or handoff information if people want to follow up or reach out to you or your work?
Yeah, sure. Yeah. So, yeah, a couple ways to find me. I'm on LinkedIn, just Jordan Guess CPA. I'm also on Twitter X at Guess_Jordan, and my last name Guess is spelled just like you think, just like the jeans brand. Um, and then yeah, I mean, we are doing services related to accounting and tax. So if you have any questions on that, we work with folks, from end to end. If that's what they want, we can file the tax return, do the planning. Or if you just have questions about Bitcoin specific stuff that your current CPA is just not comfortable answering questions about that, happy to also just do a separate engagement that's planning or consultative, and obviously then we can hand off the necessary documents or information back to your like main CPA. And then on the software side, to your point, just a tad bit earlier, we actually ran into enough of these use cases where folks are having tons of trouble tracking their cost basis across different hops, right? They buy it on an exchange, they move it to this wallet, but then they hear about this new wallet that they want to try out on their phone, so they move it to that other wallet. Then something comes up, or it's Christmas, or whatever it is, right? And they need to sell a little bit of Bitcoin to cover some cash needs. Well, when we send that back to the exchange, how do we know the cost basis? And so developed a software with two software developers. We've been working on it for actually about a year now. We launched in November of last year. That is a Bitcoin accounting and tax software similar to QuickBooks Online. So it's a double entry accounting tool. You plug in your wallets. The tool gives you bank statements for your wallets. So you can use that for a mortgage now, kind of a new thing, but you could use that to go, provide proof that, and it's just reading what's on chain, right? And you potentially have to send a test transaction to show ownership over that wallet to the lender. But at least there's a more official document now that we issue at Bitmint that shows, those monthly or annual account statements. And then for guys like you and I'm sure we're in similar situations where, have spouses, have Bitcoin in multiple places. One of the big use cases for the tool for me is to be able to show my wife, like, here's where all of our Bitcoin is on a consolidated account statement, similar to what you'd get from a Fidelity or Schwab for all your different accounts. So that's kind of one big use case, is just the statements piece alone, be it again for a lender or for just your estate documents. But then you plug those wallets in, it pushes over, you link it to a chart of accounts on the accounting side of the tool, and then you can categorize each of those transactions and mark whether they're cost basis events, if it's money coming in, or if it's a taxable event, if it's money going out. And all of that builds your cost basis schedule per lot, as well as your tax reporting for anything that you need to report the proceeds and gain or loss, short term, long term. So that's kind of one other handoff I just make sure I mention, is that if you or your CPA are just kind of overwhelmed with trying to figure out what is the tax liability for Bitcoin that you hold or that you potentially plan to either give away in a donor advised fund or need to sell at some point, yeah, happy to have a call and we can get all your wallets hooked up and give you training on the tool so you can use it. Or again, we're happy to, if you want to engage us on the bookkeeping side, we're happy to do that as well. So
wow, excellent. That's great. And as we talked about spreadsheets, keeping track of this stuff, I'm sure your software streamlines that and would be a big asset to anybody that's a Bitcoiner and doing transactions and trying to keep up with things. So thanks for sharing.
Yeah, absolutely. Well, I appreciate you having me on, Michael. It's fun.
Yeah, thank you very much. This has been a great call, and I think people will find value in it. The video last week had a lot of interest, and then even since last week, Strive Asset Management has issued their preferred, which is similar in some ways to strategies for preferred stocks. And they've also said that they expect that preferred to meet the ROC or return of capital criteria. So I think this will kind of grow as, especially these Bitcoin treasury companies issue more of these dividend paying preferred stocks. I think this will be a hot topic. So appreciate your expertise in coming in here today and helping me learn, and hopefully the audience learn a little bit more about how ROC dividends are handled. So thank you very much. So this has been B-tirement. I'm Michael. Every week I'm putting out content like this, sharing my history with Bitcoin and early retirement. And I think these preferred stocks are a key aspect of a retirement portfolio. And the fact that the dividends are tax deferred is an even bigger deal, especially in a taxable account. So I appreciate everybody joining in today. If you like this content, please subscribe to the channel and comment below if there's any open remaining questions you have, and we could do a follow-up. But please like and subscribe. Thank you.